Well, hello everyone, and welcome to our third and final webinar. It's a little bittersweet. I'm going to try and hold back the tears until the end. But I want to thank Amy for taking her time and being a part of this. It's been great, and I'm looking forward to our third one. And thank you, Amy. I also want to thank all of you in the audience who have been with us and have taken your time to listen to us and participate. So thank you very much. I'll just say in general that these seminars or webinars are great because hopefully you've gotten something out of it, but we also get something out of it because I learned something. It keeps us on top of the issues. And I have Amy, who's I also call AKA Miss Smarty Pants. So I've learned even some stuff from her, and I hope she's learned something from me. Uh, so we'll get into it. Just a couple of reminders. This is being recorded, so if you don't want to be seen or heard, turn your mics and cameras off. Also, that this is not tax or legal advice, only for discussion purposes. And Joe, IT Joe, our Chief Technology Officer, I have to add a warning. This is because of Amy, actually. Apparently, she mentioned spanking and safe words last time. And apparently, we have to put warning so no minors can be on this webinar.
I'm sorry.
Sort of joking. All right. We're going to start with Amy, who's going to recap webinars 1 and 2. 5 minutes, Amy. And then we'll get into the topic.
Okay, so my time starts now?
Yep.
Okay. All right, so we're just going to do a super fast recap of what webinar 1 was about, which was, basically the decision tree. So first, you have to figure out, do you even have a trust? And then if you do have a trust, you figure out whether it's a domestic trust or a foreign trust. And then in foreign trust land, you have to figure out whether it's a grantor trust or a non-grantor trust as to a U.S. or non-U.S. person. Bottom line there is that unless a foreign trust meets the grantor trust rules to have a U.S. owner or a non-U.S. owner, it's going to be classified as a foreign non-grantor trust, which is basically what this whole thing is about. So next slide.
Next slide.
All right. Recap of webinar 2 was the taxation of foreign trusts. So we went through how our foreign grantor trust tax with either a U.S. owner or a non-U.S. owner, and then got a little more in depth about how foreign non-grantor trusts are taxed. And did you want me to go any deeper than that?
Yeah, you got a couple of minutes if you'd like.
Okay. I think, the takeaway there is that with regard to distributions from foreign non-grantor trusts to U.S. taxpayers, is that there's this ordering rule, which whenever a distribution is made, current year income is forced out first. And it's taxed in the hands of the beneficiary, retains all of the character, qualified dividends, long-term capital gains, all of that. After all of the current year distributable net income, or DNI, is exhausted in that distribution, then accumulated income, or UNI, undistributed net income, is then forced out first. And that's where we get under, kind of the punitive rules. And I won't say any words that cause us to have a minor warning, a trigger warning or whatever. And so it's this UNI thing that, kind of causes anxiety and headaches, but also planning opportunities and whatnot. Then and only then, after the UNI is exhausted, do we get down into the non-taxable principal. So.
Thank you, Amy.
You're welcome.
Thanks for the recap. So that was webinars 1 and 2, and now we're on to webinar 3. This is where the rubber meets the road. So Amy has explained, and we've gone through 2 webinars to go through the classification, then how is it taxed? But at the end of the day, all of this has to get reported somehow to the IRS. And if there's taxes due, the IRS wants it. So I will start just as a general statement before getting into and I'm not going to go too deep into the details of the forms, just give you an overview. But what you just have to understand is the United States IRS is paranoid when it comes to non-US, what we call foreign transactions, because they don't have reporting. It's not automatic. They don't get information from banks and from non-US banks and from companies that are outside the US that are paying you consulting fees or whatever. So anytime anything happens outside of the United States, the US wants to know. It may not necessarily result in tax, but they want to know what is going on so that if they want to look further to see if there is tax due, they can. So you got to keep that in mind. It's really about mainly reporting, unless you get into the nasty UNI stuff, which has taxes. So without further ado, let's talk about first the tax reporting for a foreign grantor trust where you have a US grantor. It's kind of tax neutral from the US point of view because what's happening here is the grantor is getting taxed. So the US isn't highly paranoid in this situation but it wants to know because it's outside the US. So there is more reporting than if you had a domestic trust. And the main form is this 3520A. And there's no reason to go into the details of what it is, but here's the important highlights from the 3520A. The form itself is actually supposed to be signed by the trustee. So if you are a trustee where it's a foreign grantor trust with a US grantor, the trustee is supposed to provide this and sign it and file it with the IRS. But although the trustee is the one that's supposed to be signing it, it's actually the US owner who's responsible for ensuring that the trustee does do so. So that's a little quirk, but it's an important one. Also, what's important is that the trustee must provide the US owner what's known as a foreign grantor trust owner statement. And if there's been a distribution, also a foreign grantor trust beneficiary statement to the owner, if there's one to the owner. And if there are any other US beneficiaries, that also the trustee must provide a foreign grantor trust beneficiary statement. We'll get into a little bit what happens if you don't. The third point, just to highlight here, is when you're dealing with foreign trusts, if you don't appoint a US agent, then the IRS, again, paranoia sets in and says, we want to see all the documents and we want to get a copy of all amendments and the whole history of the trust. So most trustees don't want to give that information to the IRS, and for understandable reasons. And it's probably not necessary. So if you appoint an agent, you can avoid all that. And what the agent really does is it's just someone who is a US person that agrees to provide the information to the IRS upon request, because the IRS has jurisdiction over US persons as opposed to non-US persons.
So a lot of I advise a lot of foreign trustees on these types of things, and they kind of freak out when they see they're appointing a US agent, and I'm like, well, no, it's just a US tax agent. It's just someone that the IRS has jurisdiction over in order to get the information it needs to determine the tax attributes of the trust. So
yeah, I've been appointed an agent on numerous trusts. I've yet to ever receive a request.
Yeah.
I don't know if you have, Amy. Okay, so that's US foreign grantor trust with a US grantor. There's another part too, because specific to US grantor, which is this form 3520. So if, in addition to the 3520A, when you have a US grantor or a foreign grantor trust, that grantor, US grantor, also has to complete part 1, usually if there's transfers to the trust, because the IRS wants to know when money's leaving the United States. The US owner is always going to have to fill out part 2 as the owner. And if there's been a distribution, then part 3 has to be filled out. Part 4 is on the same form, 3520. It's gifts, so we're not going to get too much into that. I think if at the end we have a special treat for you guys, where Amy and I are going to talk about some special issues. We'll get into the gifting issue and reporting side of it later. One note here that I need to mention is that there are some proposed regs that have just come out. So some of these forms may change slightly, but probably for the most part will be the same. Obviously, we'll update you when that happens. Okay, so 3520 and 3520A when you have a US grantor. And there we go. Oh, excuse me. Jump. Okay, when you have a non-US grantor, this is where we're in heaven from a US tax perspective, because as Amy explained earlier, when it's a foreign grantor trust with a non-US grantor, from the US perspective, it's not taxable unless this little oddity if it has US source income. And in that rare instance, you would file the trust would file a 1040 NR. Otherwise, the trust itself has no reporting to the United States because it's not taxable to the United States, considered a US, it's a non-US entity. And so there's no connection unless there's this income that's coming, US source income. So what is the reporting when you have a non-US grantor of a foreign grantor trust? Only if there are US beneficiary distributions to US beneficiaries. And that's where that foreign grantor trust beneficiary statement comes in. Part 3 gets filled out. Now, if you have a foreign non-grantor trust, so you go from heaven to potentially hell. And this is the accumulation distribution rules. This is where the taxation, the UNI, the DNI, the throwback tax, this is where it all happens. But once again, the trust, because it's non-US, because it's foreign trust, it does not file anything. It's the foreign non-grantor trust beneficiary statement that has to provide information to the US beneficiary so that they can properly and adequately report the information. Now, 2 points here, and this is for trustees that are handling these types of trusts that are foreign for US tax purposes. If the trustee does not provide a beneficiary statement for either case where it's a grantor trust or non-grantor trust, the IRS will then assume that it is a accumulation distribution, and then you fall into the default rule. So those beneficiary statements are vital. There have been cases where trustees have said, well, we don't provide it unless the beneficiary asks for it. I don't think that happens as much today, but I can tell you that was kind of the practice 10 years ago, maybe. Less and less so, but it's really important that you provide it. And our general advice, this is not specific advice, is that you should be providing it and let the beneficiaries decide what they're going to do with it. They can throw it in the garbage, but hopefully they report it. And then again, it's in part 3 where all the information falls.
So I realized, I can't remember if you mentioned the form 4970, but you think I'm smarty pants, but I don't think we mentioned it.
No, we didn't. No, please do.
Yeah, so there's we're gonna have a list of forms that Milan is gonna go through, but we should jot down in your notes and maybe when we post the
final
thing. But there's I think it's a 4970. That's the calculation of the throwback tax. So
yeah. Thank you. You're right.
It goes along with the 3520.
Yeah, it's not, and I've prepared that. It's not fun.
No.
What happens if you don't file? It gets pretty nasty. The penalties are significant. This is why I said reporting is where the rubber meets the road, because if you don't file, it is pretty hefty. It's the greater of $10,000 or 35% of the gross reportable amount on what should have been reported. Then the IRS will throw in, and then I've seen them do this with the continuation penalty, where after you've been notified to file and you still continue for whatever reason not to, then they will add on to that and add this continuation penalty. So it can get pretty nasty. What I will say though is that there is some relief that you can get. You can go in for reasonable cause if you can show the IRS that there was no willful neglect. One thing that has come up a lot in the past is, well, the countries where my trust is located or my bank account's located, it has secrecy laws and I can't then get the information. IRS doesn't care. That is not reasonable cause. If you do have a foot fault or if it's willful, there's kind of two programs. The willful one falls under the voluntary disclosure practice. And this is where you have to go to the IRS first before they come to you. And you tell them, I'm sorry, I did this, it was wrong, and correct it. I did a lot of those with the voluntary disclosures when I was in Switzerland. At that time, it was called specifically the offshore voluntary disclosure program. IRS kind of relented on the willful, non-willful issue and came up, thankfully, with the streamlined methods, which is for non-willful, which by and large were most of the cases I dealt with. And then there are a couple, this DIRSP and DFSP. That's for, these are cases where there's no unreported income, but you still fail to file the information with the IRS, and you can correct it through these mechanisms. And if anyone has questions about that, you can contact us later for more details. All right, I think I hit the mark. I'm going to go through, these are the forms. I'm not going to go through them because we're at 15 minutes. So they're all here. I'm just going to quickly highlight FinCEN form 114. That's the FBAR. A lot of you have probably heard about it. That's also has some hefty fines. So that's an important one. If you have a U.S. person that has an interest in a financial account outside of the U.S. with 10,000 or more aggregate or signature or other authority. So it doesn't just mean that they have the account, it's signature or other authority. These are some of the corporation business entity filings. So you can see beyond trust, which is 3520A and 3520, there's a lot more to be filed out there. So kids, don't do this at home alone at night. Get help. These are the trust and estate forms. These are some other forms for withholding. You've probably seen the W8BEN, the W8E. Those are all fun. I'm going to get to our treat, special issues involving foreign trusts.
Okay, so
Back to you, Amy.
Yes, I'm going to start with the first two bullets, hybrid trust and reverse hybrid. A hybrid trust is one, and don't ask why, because it's a long discussion, and Milan said it's boring when I explain the why. But a hybrid trust is kind of a term that we coined a long time ago for a trust that was, situs, let's say in Liechtenstein, for example, some offshore jurisdiction has an offshore trustee, Liechtenstein trustee, governed by Liechtenstein law, all of that. But we want it to pass, the court test and the control test. So we appoint a U.S. co-trustee and we put special language in there and make sure it's administered in a way that it's a U.S. trust for tax purposes. A reverse hybrid trust is the reverse of that. So this is a little bit newer, and I don't know if these terms are actually legit terms. I just kind of came up with reverse hybrid a while back. And so a reverse hybrid is let's say there's a Wyoming trustee, but we want it to be a foreign trust for tax purposes. We'll put foreign protector on that has control over one substantial decision, and now it's not a U.S. trust. So this is going to be the thing that our non-U.S. clients and audience are going to be most interested in. And I think I'm allowed to say it because the U.S. is not a common reporting standard jurisdiction. So this is basically, it got very popular with families who live in CRS jurisdictions who want a trust that's not taxed as a U.S. trust, but it's considered a U.S. trust for all other purposes. So there's, in other words, the like Wyoming trustee in my example doesn't have any kind of automatic exchange obligations under CRS.
So, yes, that's a really great point there. I'm a little hesitant about the name that you've coined for it, reverse hybrid trust. I think we might need another warning label for sexually explicit
Oh,
terms.
come on now. All right, now you've got us. Now we have to have a warning. It's your fault this time.
Thank you again for another warning that we need, because it sounds very familiar to reverse cowgirl or something like that.
Oh,
I've
come
seen
on.
them.
Okay, Milan.
Anyway,
over,
back to the topic,
I didn't want to out you on the being hungover thing, but yeah, there you go. You're hungover.
So the concept though is great, because what happens with this reverse hybrid trust is that you have a trust in the US with a US trustee, a US law, but yet it's foreign classification. So you can have all of that, but yet get that nirvana, that heaven of the taxation world. And that's the beauty of it.
Let me say though that the reason that I would have these foreign families come to me. Nobody's a U.S. person at all, but they want a U.S. trust, and I was like, well, you don't want to set up a U.S. trust because now you're subjecting all the assets to worldwide taxation, right? Because it's a U.S. trust, and so we just fail that foreign trust thing by just giving a foreign person one substantial decision, and now it's taxed as a foreign non-grantor trust. And the foreign beneficiaries, they don't care that it's a foreign non-grantor trust because they don't have to worry about D&I, U&I, all the reporting and all that kind of stuff.
Yeah.
So
it's a great little thing. We'll just come up with a new name. How about intentionally an intentional foreign trust?
Okay.
Maybe.
We'll talk offline.
Anyway, we'll talk about it later. Okay, so I'm going to cover the two next points, the U.S. estate tax issue and the Form 5173, because they're kind of go hand in hand. Key to what Amy just mentioned with the reverse hybrid trust is that when she was talking about income tax, but what some people don't always know is that there's an estate tax also in the United States. And what happens here is there's this nasty little estate tax. Well, for US persons, it's going to be 15 million per person. So that covers most people. They're okay. But for non-US people, the exemption is only $60,000. So if you have one of these trusts and you're invested in Apple stock and it's over $60,000, and the settlor, grantor, passes away, there is going to be an estate tax issue in the United States if you have direct holdings through a foreign grantor trust. So that's something to be aware of and be alert and know that there's this estate tax issue lurking in the background.
Yeah, because keep in mind that in order to have a foreign owner of a grantor trust, it has to be revocable, basically, or the foreign person has to be the only beneficiary during their lifetime. And those are estate tax retained powers. So great for income tax because you have a foreign grantor trust with a foreign grantor, but not so great for estate tax if the trust directly holds U.S. estate taxable assets. So that's why we would need to put a blocker entity into that type of a structure.
Right. And so with that, that's hence the blocker, which helps with the estate tax issue, but a little complicated to get into detail here, but just be aware of that issue. Why is it also important with this estate tax issue? If I have news for everyone, we are all going to die. So as much as your clients think they are not going to die, they are going to die. And when that does happen, it will be sad. But what also happens is if they have assets in the United States and it's custody with a bank, these banks will not release these funds without this Form 5173 transfer certificate. And that is taking longer now because basically the IRS is shut down. So anyway, that that's an important form to just be aware of, particularly if you have US investments, which is why, again, the blocker avoids that problem. So tying back into the blocker. We have 5 minutes in.
Okay, so I'll just do this one real quick. Strategic distributions. When you have a foreign non-grantor trust that has a class of beneficiaries that consists of US persons and non-US persons, there's some ways to cleanse the UNI out of that trust by, using distributions to the non-US people. Essentially in a nutshell, well, you can't distribute to the foreign people and then have them gifted over to the US people, because there's that, that loophole, that cutesiness.
Yeah, you're cute loophole.
Yeah, too cute. But you can make distributions in like year one to the non-US people, legit distributions to the non-US beneficiaries, cleansing out the UNI of the trust, not subject to US tax because they're non-resident aliens. And then in the next year, make distributions, start making distributions to the US people. You have to stagger it across calendar years, because if distributions are made to a bunch of beneficiaries, US and non-US, in the same year, each beneficiary has to pick up their pro rata share of the DNI and UNI. So you got to cleanse it out first year, and then after it's cleansed out, then you can start making distributions to the US people. And that's some like true up fairness discussions that come into play, about blah, blah, blah. But that's basically the strategic distributions.
Thank you. We got 1 minute left for each point. Okay. So I'll go quickly. Going back to the fact that your clients are going to die, but if they didn't plan properly, one of the nice, cute techniques that's valid is what I call GPOA planning. I love it. I've used it. Amy's used it. It basically allows you to reset when you get into that nasty world of accumulated income. The GPOA planning is a way to resettle. It's a little complicated, so we can't get into it. I only have a minute. Just be aware, it's one of the tools that you can use.
Yeah.
Amy, outbound.
Okay, outbound trust migrations, just be careful, like if you have a typical, let's say, crummy trust created by a US person for US son, and it's a non-grantor trust, and then son and father get crossways. I'm just talking about my particular client situation. They stop talking to each other for years. And then son decides that he wants to move his trust to the Cook Islands, appoints a Cook Islands trustee. Boom, all of a sudden he's got a foreign trust, and now it's a grantor trust as to dad, who didn't even know it. Yeah. Now there are some kind of grace provisions, for not getting dad in trouble since he didn't know about it, but just, kind of
be aware.
It's not, yeah. So if you have a US non-grantor trust that moves offshore, and the US grantor will be the owner.
Yeah, be aware of that automatic rule. That it can bite you.
Yeah.
Inbound pre-immigration trust. That there's planning that is valid and works if you have non-US people who are coming to the US and they set up a trust 5 years in advance, it works. Here's where you have to be very careful, because I actually just got a case last week where Canadian moving to the US. I don't know why, but anyway. It's not just that it has to have certain rules, but what happens is when you come to the US, you also have to start now looking at the retained power rules. And they always, when you have certain drafters who aren't aware of that, they mess that up. And that's something to be very aware of. Old trust.
All right, I'll go quickly. Old foreign trust. I just wanted to mention that I've seen a lot of old, like 1970s, 1980s trusts created by non-US family. Everybody's offshore, and then boom, next thing you know, in 2010, great grandson becomes a US citizen, and the foreign trustee is like, uh-oh, what do I do? Because that US beneficiary, even though maybe they weren't even born when that trust was created, they're going to get smacked with all of the UNI from inception. So there's some planning around that.
And last but not least, protective filings. Plug for my work. Keep me busy, put food on my table. No, protective filings can be your friend, because I'll give you an example. I have a we have a case that I'm working on. It's actually the largest IRS criminal tax case that's in the history. Anyway, the person has, due to the circumstances, they're below the $100,000 threshold because money's coming from a non-US spouse, but we're declaring it because we don't want to have it considered as income. So even though there's not a requirement to file, in this case, we are filing protective 3520s to report the money coming from the non-US spouse to the US husband. And we call these protective filings. So protective filings can kind of save you. And the other main reason for protective filings, I have another different situation where you don't have there's zero income for a partner, of non-US partner, and in a US partnership, there's no income coming out. But if you file the return, it triggers the statute of limitations. So the IRS can't come back to you and say, hey, you owe us money. Whereas if you don't file, what happens, Amy?
They come asking for the money. Well, so if you
when
don't
does this-
file, it holds the statute open
Forever.
forever, like forever. So
If you don't file, the statutes never start running. So that's why protective filings can be your friend.
yeah.
Well, that wraps it up. Thank you all again. Wishing for you, those of you in the United States, wishing you a great Labor Day weekend. For you, those of you further south, I will be at STEP LATAM in Mexico City. So if you are on this, attending that, would love to meet you in person and hope to see you there. Thank you. We will plan to do more of these, hopefully, if Amy's willing to. And we have a tax blog. So Amy's been kind enough to share some information. So we'll be sharing that. We'll try to make the information relevant. So you can always unsubscribe, but we'll really try to make it relevant and worthwhile. And we'll announce upcoming webinars that we think of. Thank you.
Thank you.